Sterling and the UK government bond market have been in meltdown as a result of the government's mini budget. So in this video we look at the reasons behind that market reaction, but also consider what might happen in future for the UK economy and markets. So let's look at the UK economic crisis, what happens next, in a bit more detail. Let's start off by looking at some key points from the mini budget. You can read this for yourself in a 40-page document, which is beside me here, the Growth Plan 2022. Now, one thing that the government didn't have a choice about is the energy price guarantee. They simply had to do something about that. Otherwise, UK energy prices would have simply gone vertical over the course of this winter. Now, the energy price guarantee that they came up with should reduce inflation over the short term. However, the way they've chosen to fund it is looking very risky. Effectively, what they have is unlimited downside if energy prices spike over the course of winter. And unfortunately, this has coincided with huge tax cuts, the largest we've had for many years. Now, this has created a huge load on the UK bond market because if you issue lots of new government bonds, then that tends to push down their prices. Lots of supply without a huge increase in demand does that. Also, the government's tax cuts will exacerbate income inequality, but also regional inequality in income across the UK. However, the growth plan is not all negative. Certainly one of the big positives is that it acknowledges that we have a problem with growth and productivity growth in the UK. Another positive is greater spending on infrastructure, so improving the road and rail network, as well as energy production and decarbonisation, and the digital infrastructure for Britain. Now, one of the things that's rattled the bond market in particular, but also the currency market, is that the UK is running a double deficit. Now, this is something which is often a red flag for an emerging market economy. The first half of that twin deficit is a current account deficit, which roughly means that the amount of exports is less than the amount of imports. So the net position is that capital's flowing out of the country. At the same time, you've got a fiscal deficit, which means the government is spending more than it earns in taxes, and the difference has to be plugged by issuance of more government debt. Now, what you'd expect to see for an emerging market twin deficit is that there'd be a currency devaluation, and that's exactly what we've seen in the UK. But another way of characterising a twin deficit is to say that you're borrowing from foreigners to buy foreign-made goods. Or as Mark Carney put it very succinctly, he was the previous Bank of England governor, the UK is now relying on the kindness of strangers. Now, strangers are probably willing to buy UK government debt and to carry on being kind as long as the government's seen as being responsible in its debt issuance. However, having tax cuts at the same time as massively increasing spending is seen as irresponsible. So that's part of the worries, I think, behind what's made gilt yields spike upwards. And the current account deficit is very large, as you can see in this tweet from Robin Brooks. Currently it's running at 8.3% of UK GDP. A large amount of that comes from the fact we've had to import energy at vastly elevated prices because we're paying for it in a weakened sterling and it's priced in dollars. So as the value of sterling devalues further, that problem's going to get worse and the current account deficit will get larger. Now, one of the things that worried markets was that the Office for Budget Responsibility was not asked to estimate how much this plan is going to increase UK debt. Fortunately, NISA has done that for us. That's the National Institute for Economic and Social Research. So you can see that before the budget plan, the public sector net borrowing was actually going to fall over the course of the next few years. But as a result of the mini budget, you can see that that spiked to 8% of GDP in 2022 and 2023. And that's going to remain elevated, so there'll have to be more issuance over time for several years. What does that mean about the level of GDP debt relative to our income? Well, it's going to increase it. Not hugely, but certainly more than we'd have expected if there hadn't been the mini budget. So just over the next 6 months, if you read the plan itself, they say they're going to have to issue an additional 60 billion in gilts. But it doesn't stop there because over the next 2 years, some estimates put the additional issuance of government bonds between 100 billion and 200 billion. Now, fortunately, the UK has a bit of wiggle room when it comes to government debt. So the debt to GDP ratio, according to the Office for National Statistics in April, was that we were roughly at 100%, which means that the amount of debt out there, which is outstanding, is roughly equal to the UK's GDP. The US, for example, is at 133%. Compared with the EU, we've actually got a little bit more. So the EU average is 90%. But if we compare with the rest of G7, the rich countries, you can see that their average is pushed up hugely by Japan, which has disproportionately more debt than any other country. Their debt to GDP ratio is over 260%. But I think the sustainability of UK debt is certainly one of the issues which has worried markets. Now let's turn to the market reaction. This is the value of sterling versus the dollar over the course of the last week or so. You can see the reaction to the mini budget was very brutal and very rapid, particularly for a developed market currency pair. To some extent it is now stabilized, but as we saw, the current account deficit will suffer further from having a weaker pound. Energy imports are just going to get more expensive as sterling weakens. Now, people usually focus on the value of sterling versus the dollar, and it certainly is one of the largest currency falls over the last week. It's down by about 5%. At one point, it was down by about 7%. However, this isn't just a story about dollar strength. If we compare with any of the other major currencies, whether it's the euro or the Japanese yen, sterling's weakened versus all of them. So this is a direct result of the mini budget and people's loss of faith in the UK economy. And it's unfortunate that every time there's a crisis, sterling weakens versus the dollar. This is data going back to 1970, and I've marked UK recessions here as the blue bars. And on average, sterling has weakened by about 1.5% over that 50-year period. Now, there are periods during which sterling rallied versus the dollar, but it seems that every time there's a crisis, there's a weakening. So it happened during the high inflation period in the 70s. It happened again with the dot-com bubble, with the global financial crisis, with Brexit in 2016, and the latest weakening is due to this mini budget, such that over the course of 50 years, the value of sterling versus the dollar has more than halved. Is sterling currently oversold? I think that's possibly true. If you look at purchasing power parity, you'd expect it to be much higher than it is today. So perhaps this was an overreaction. Another place where there's been a very brutal market reaction is in the bond market. So here you can see the cost of government borrowing for the UK government over different periods of time. It's called the yield curve. So if the government borrows over a 1-month period, these are the rates it pays. And if it borrows for a 30-year period, these are the rates it pays. And this shows 3 lines, which is where the yield curve was a month ago, a week ago, and most recently. Now notice that the entire yield curve has shifted upwards. When the yields go up, the bond prices go down, and the rate of increase has been utterly shocking. So here you can see the UK 5-year yield, which has essentially gone vertical over the course of the last week. Why does this matter? Well, if you've got a pension, it's going to have UK gilts in it. And if you look at the price of those gilts, they've simply fallen off a cliff. So for long duration bonds, which are very sensitive to interest rates, those have started weakening over the course of this year. That's true of any developed market. But as a result of the idiosyncratic risk for the UK, those have fallen much further over the last week. Now, what was previously seen as much safer is shorter duration UK gilts. Well, those too have sold off massively. So if you're a pensioner who's in retirement, then you'd expect to see safety in UK government debt. However, over the course of this week, people's faith in that safety has been hugely rattled. Another reason why government debt yield matters is because all other interest rates are set on top of it. So when the government yield increases, it's like a boat rising on a tide. All the other rates increase as well, and that includes mortgage rates. So due to the volatility in the UK gilt market, several mortgage lenders, such as Virgin Money, Skipton Building Society, but also Halifax, have actually had to withdraw products to reprice them. You can bet that when those go back onto the market, they're going to have much higher interest rates. Now in the UK housing market, it makes up about half of UK wealth. So it's going to have a huge psychological effect, I think, when we see house prices fall as a result of funding costs increasing massively. The government's tried to reduce that shock by reducing stamp duty, but I think higher interest rates for mortgages are simply going to make a lot of current prices unavailable to a lot of people. So I think this will have a negative effect on the UK housing market. Now, if you want to keep abreast of economic news, but also how it affects markets, a great way of doing that is by signing up for our free weekly market roundup. I try to keep it short and punchy. I publish it every Friday, and of course, it's absolutely free. To learn more about that, just click on the link beside me or in the description beneath me. The most expensive part of the government's plan is its energy price guarantee. That's guaranteed to ensure that the average household won't pay more than £2,500 over a period of 2 years. There's also a plan for businesses and public sector organisations like charities, but that's only going to run over a 6-month period. And the government says that these policies will significantly reduce inflation and support growth over the short term. Now that's all good because the government had to do that. It certainly had to help vulnerable households over the course of the winter. But I think the way it's chosen to fund it is very problematic. Effectively, what the government's done is to take a huge short position in electricity and gas markets. And that's because it's decided to set a price cap. Now, any difference between the wholesale price of energy and that price cap will be made up by the government, and it'll fund that with government bond issuance. In other words, what it's got is a huge short position. Now, if the wholesale energy price is below the price cap, it could end up with a profit. If it's greater, it actually has a loss. And the extent of that loss is unlimited. If we have a really cold winter and energy prices really spike, or say if Asia outbids Europe for liquefied natural gas, then these prices could go crazy and the government will have to pay the entire downside. Now that is a kind of position with such huge risk that it would make a hedge fund blush. And on the question of whether it reduces inflation, again we can turn to the NISA report, and they certainly show that it does reduce a little bit over the short term. However, over the longer term you can see that it actually increases inflation a little bit, and it'll take longer to come down to 2%. That's because the tax cuts are inflationary. But certainly based on NISA's forecasts, the overall effect on inflation will not be huge. But certainly it'll take some of the pressure off the Bank of England in the short term for getting inflation down to its target. Another problem is that by being inflationary, the Bank of England will have to do a lot more work to get inflation under control. Or if we wanted to visualize that, you could see it as a kind of seesaw. Government implements fiscal policy, so it's their job to try and spend money to stimulate the economy and create more supply of goods and services. And then on the other side, we've got the Bank of England and Andrew Bailey, the governor, whose job it is to get inflation under control. Unfortunately, they're pulling in different directions. The tax cuts are seen as being very inflationary, whereas the Bank of England is going to have to be much more aggressive in order to get inflation under control. So again, turning to that NISA report, before the mini budget, the expected policy rate for the Bank of England topped out at about 3%. Remember, your mortgage will depend on this rate. Now that we've had the mini budget, the forecast rate is not much less than 5% in order to counteract the inflationary budget. Now that's going to create a great deal more pain for the housing market and for people who've borrowed money, primarily in the mortgage market. But there'd also be pain for companies which have got bank loans or have borrowed in the corporate bond market if they have to roll over their debt. And what's particularly shocking is that markets are pricing in these much higher interest rate increases from the Bank of England almost immediately. As Alberto Gallo points out, a macro strategist, in this tweet, he says this is going to create emergency interest rate hikes and a sudden stop in credit, which now becomes much less affordable. So this is what the market is currently pricing. Each of these dates you can see is one monetary policy meeting in November and December of 22, then February, March and May and so on in 2023. And these are the size of the rate hikes, rate increases, measured in units of 0.25%. So notice that the implied rate now is going to end up about 3.2% above where we are today. In other words, we'll end up not much less than 6% according to current market pricing. So that's going to be particularly painful for the housing market if that comes to pass. Now, in order to settle nerves, the Bank of England had to say something. Unfortunately, what they said was that they wouldn't hesitate to change interest rates by as much as needed to get inflation back to 2%. In other words, they sounded very hawkish, and markets didn't like it. So as soon as this tweet came out, sterling fell again. The government's also come out and said that in November it's going to ask the Office for Budget Responsibility to price its new plan. However, this probably has come too late to regain credibility. Finally, we'll turn to the question of whether tax cuts increase growth. And according to NISA's model, yes, they will. So this is the effect of a corporation tax cut on GDP growth in the UK, and you can see over the short term, it does indeed increase GDP. However, the assumption that they've made is that any extra cash which companies get to keep will be spent on reinvesting into the business. That's what produces growth after all. However, if we are going to enter a period of economic weakness, I think what's more likely is that companies will hoard cash. That's because they'd expect to see less demand for goods and services during the weak period, and they just want to survive. Now, there are incentives in the government's plan, tax incentives, to try and get companies to invest more, but we'll just have to see whether that actually comes to pass. UK companies typically have been quite hesitant to reinvest. But what's definitely true is that the way the government's chosen to implement the tax cuts will increase income inequality hugely. Notice how the group which benefits disproportionately relative to the others is the 20% of households with the greatest wealth. And the largest gain, that's the red bar you can see here, is because of the reduction of the additional rate of income tax. And if we look at the regional differences, notice how it disproportionately helps people in London and the South East, where incomes and wealth are generally higher anyway. In the poorest regions of the UK, generally the benefits are much smaller. In conclusion then, there are some positive aspects of the plan, primarily that we've got one, and the UK government is actually going to try and address weak growth and productivity growth in the UK. The increased spending on infrastructure is very welcome and probably very positive for growth, and the energy price guarantee had to be implemented. Although the way it was implemented via this big short in the energy markets is probably going to cause problems down the road. Also, the timing of the tax cuts is very unfortunate, and that's certainly rattled markets when they worry about debt sustainability. Furthermore, part of the productivity problem in the UK is due to regional differences in wealth and income, and this plan has actually made those differences larger. So it's understandable, I think, that markets were rattled by the way this plan was presented. If it had been presented as something like a war budget, which is effectively what it is, then I think that might have been taken better. But still, we are where we are. And remember that these kind of crises create opportunities. So if you are thinking of buying UK equity, it's certainly looking like a bargain right now. Will it get worse from here? I think it might, but still, valuations at these levels will generally be attractive over the long term. So don't forget our offer if you want to learn more about markets and you want to keep abreast of what's going on in markets and the economy, then sign up for our weekly market roundup. It's completely free, and you'll find a link about that beside me and in the description beneath me. And as always, thank you for listening.